What makes a millionaire different from you insider secrets, lucky timing, or the way they use their very first 100? Be honest. If I handed you a single crisp bill and a laptop right now, would you know how to turn that 100 into a quiet engine that keeps working for you while you sleep? Or would you let it vanish into coffee cups, subscriptions, and a few forgettable clicks? Today, I'm going to make that 100 unforgettable. I'll show you how beginners can invest online from scratch, how 5 popular paths actually behave in real life, and how to choose the one that fits your temperament so you don't quit halfway. I'll judge each option with 5 yardsticks learning curve, passive income potential, tax efficiency, risk level, and real results from a simple 4-year experiment. And I'll do it as if your attention is the most valuable asset in the room. Because it is. Here's the promise. By the end of this lesson, you'll have a clear plan you can execute from your laptop in under an hour, even if you've never invested before. You'll know exactly what to do with 100 today, what to do with your next 100, and how to build a system that compounds whether markets are calm or chaotic. No hype, no jargon traps. Just a professor's job done right. Keep you engaged long enough to install habits that outlive motivation. Let's set the stage with a simple truth. Beginners rarely hear. Your first 100 is not about the money, it's about the machine. Your goal is to install a system that keeps moving tiny amounts from your spending world into your wealth world with minimal friction and maximum durability. Every technology, every app, every investment we discuss is just a belt or a gear in that machine. That mindset alone will put you ahead of most beginners who treat investing like a lottery ticket rather than a system. Now, how do we rank the options? I'll use 5 practical yardsticks you can remember without a spreadsheet. First, learning curve. How hard is it to get from "I have no idea" to "I can do this without sweating"? Second, passive income potential. Can it pay you while you still own it without you having to sell? Third, tax efficiency. Can you legally keep more of what you earn by using the right account type? Fourth, risk level. How likely are you to lose money, and how violently can prices swing? Fifth, results. What happened to a simple 100 invested 4 years ago with a beginner-friendly approach? I'll weave these into the story so you feel them, not just hear them. Before we dive in, a human note. I'm not your financial advisor. I'm the professor who gives you repeatable models, clear examples, and sound guardrails so you can make informed decisions. You must still do your own research and consider your country's laws, your income, your debts, your emergency fund, and your temperament. Investing is personal because sleep is personal. If an approach keeps you awake at night, it's wrong for you even if someone else boasts about it online. Let's start with the path that seduces almost everyone. Owning individual stocks. The allure is obvious. You like a company. You believe in its future. You want to own a piece of it. That feeling is real and, when harnessed correctly, can be educational and profitable. But the learning curve is not what social media makes it seem. Picking individual stocks well consistently over time requires reading financial statements, understanding how a business actually makes money, evaluating leadership, and most of all, recognizing the difference between a great company and a great investment at today's price. A wonderful business bought at an absurd price can still disappoint you for years. As a beginner, there's a trap, random selection masquerading as strategy. 4 years ago, to illustrate how fickle luck can be, a 100 pick landed on Samsung in a randomized selection. Over the period, that position fell to about 67. 66, with roughly 10 cents in dividends along the way, around a negative 32. 34, return. Painful? Yes. Predictable? Also, yes, if the process is basically darts. Now, what if that dart had landed on Apple, Microsoft, or NVIDIA? That same 100 would have become roughly 170, 188, or an iPop 908. The lesson here is not missed opportunity equals failure. The lesson is selection drives outcomes. And without a repeatable selection process, you aren't investing. You're entertaining yourself with risk. So, what's the smarter way to use individual stocks as a beginner? Treat them as your skills lab, not your core wealth engine. Use an app's demo mode or paper trading to practice without real money. Build a simple checklist before any purchase. Does the company have durable advantages? Is revenue growing healthily? Are profit margins stable or improving? Is free cash flow positive? Is debt reasonable? Do you understand in one sentence how it earns money? Could you hold this for 2 to 10 years without staring at the price every 15 minutes? If your checklist is shaky, don't buy yet. And even when you buy, keep position sizes small. This keeps the learning curve manageable, the risk contained, and your sleep intact. Dividends can add a trickle of passive income, but remember, not all stocks pay them, and a dividend does not immunize you from a price drop. Let's pivot to something that sounds complicated, but is beautifully practical once you grasp it. Real estate investment trusts. Think of a RIAT like a COPE for property investing. Thousands of investors pool money. The trust buys income-producing properties, offices, apartments, warehouses, data centers, retail, even hospitals, and rents them out. The law in many regions requires REITs to distribute the majority of their profits to investors, often at least 90. That single rule is why REITs are known for steady dividends. You don't need a mortgage. You don't need a 6-figure down payment. You don't need to fix broken boilers at 2 a.m. You can buy shares from your laptop and collect your slice of the rent. The learning curve is moderate. You should know the difference between property types, occupancy rates, debt levels, lease lengths, and how interest rates affect financing costs. But you don't need to become a landlord. The passive income potential is often great, precisely because of those legally required payouts. Tax efficiency can be excellent if you use a tax-advantaged account in your country like an ISA in the UK or other sheltered accounts elsewhere, though the details vary, and you must check your rules. Risk sits around medium. REITs diversify across many properties, but they still live in the real world. Pandemics, empty offices, interest rates rise and make debt more expensive, retail shifts online, towns boom and bust. What did 100 do across 4 years in one example? Price alone dipped slightly, down to around 98. 59 at one point, but dividends of roughly 11. 93 turned the overall result into about a plus 100 at tennis. 52 gain. Notice the pattern. Price down a touch, but income made the difference. That is quintessential REIT behavior. Your returns can be a blend of price and rent, not just a bet on appreciation. Next up is the volcano that fascinates and frightens in equal measure, cryptocurrency. A handful of lines of code, a global network, and a new way to define scarcity. Bitcoin and Ethereum are the blue chips, here battle-tested, widely held, and the backbone of an entire ecosystem that keeps reinventing itself. The learning curve is moderate because you must learn new mental models, wallets, private keys, on-chain transactions, custodial versus self-custody, security hygiene. A hot wallet connected to the internet is convenient but vulnerable. A cold hardware wallet is inconvenient but far safer. Exchanges make buying easy, but each comes with its own risks, fees, and regulatory posture. Do not skip the security lesson. In crypto, personal responsibility isn't a slogan. It's survival. Passive income potential exists through staking or lending, but it comes with layered risks, protocol risk, smart contract risk, counterparty risk, and simple price risk. An attractive yield can be obliterated by a price drop, a hack, or a platform failure. That's why many prudent investors hold their core positions in cold storage and avoid the yield chase. tax efficiency is generally poor. In many jurisdictions, swapping one coin for another is taxable. Staking rewards are often taxed as income, and you usually can't tuck crypto inside the tax-sheltered wrappers available to stocks or funds. Risk is very high. Prices can climb 500 and then fall 80 quicker than you can build a plan. The 4-year 100 snapshot in Bitcoin, about 652, 24 roughly a 552 gain. Astonishing? Yes. Guaranteed? Absolutely not. Plenty of smaller coins have gone to zero. Treat crypto like fire. It can cook your dinner or burn down your house, depending on how you handle it. Let's cool the temperature with something ancient. Gold. Humanity has trusted it for thousands of years. It doesn't rust. It doesn't default. It doesn't declare bankruptcy. It just sits there, quietly reminding economies that trust sometimes needs a physical anchor. The learning curve is low. You can buy physical coins or bars and decide how you'll store them, or you can buy an exchange-traded fund that is backed by physical gold and gives you price exposure with a click. Passive income potential is zero. Gold does not pay you while you hold it. It is a store of value, not a producer of value. Tax efficiency can be good or nuanced, depending on your country's rules. Some coins are treated favorably, some aren't, and funds can often be held in tax-advantaged accounts where available. Risk sits around medium. Gold is historically resilient during inflationary periods, crises, and currency wobbles, but it can underperform growth assets over long stretches. The 100 result after 4 years? Around 140. 10 dodge, about a 40 gain. Solid, unexciting, exactly the personality you sometimes need in a portfolio. Finally, the quiet champion that wins more often than it trends on social media, broad market index funds. Imagine buying a tiny piece of the 500 largest companies in the United States with one purchase. No guessing who will be the winner. No late-night earnings calls. No dartboard. You accept the market's average, and because of ultra-low fees and relentless reinvestment, that average tends to beat the majority of stock pickers over long stretches. The learning curve is low. You choose a broad fund, set an automatic contribution, and go live your life. Passive income potential is moderate. You'll receive dividends from the companies inside the fund, and you can reinvest them automatically so your share count grows without you doing anything. Tax efficiency can be great inside the right account. Roth IRAs in the U.S., stocks, shares, ISAs in the U.K., TFSAs in Canada, and other vehicles where available. Risk is lower than single stocks because you're spread across hundreds of businesses. But it's not zero. The market will still drop, sometimes sharply, and you must stay the course. The 4-year 100 snapshot, roughly 179. 57, about a 79. 57 gain, not the best of the bunch in that specific window, but consistent, boring, and sane. Now, let's put these side by side in your mind without a chart, just a clear takeaway for a beginner, with 100 nerves of a normal human being. Individual stocks can teach you valuable lessons and sometimes deliver spectacular wins, but they punish randomness and impatience. REITs can quietly pay you to wait, especially if you choose solid properties and manageable debt levels, though they're sensitive to interest rates and economic cycles. Crypto can change your life or chew it up. A small, disciplined allocation with strong security is the only intelligent way to approach it as a beginner. Gold is portfolio, ballast calm, crisis-friendly, and yawn-inducing in a good way. Index funds are the default for a reason. They work for most people most of the time with minimal effort and maximal survivability. So, what should a beginner actually do today with 100? I'll give you 3 models. Choose the one that fits your temperament right now. You can evolve later. If you want sleep-first simplicity, put the entire 100 into a broad index fund inside a tax-advantaged account, if your country offers one. Turn on dividend reinvestment. Set a recurring contribution for your next paycheck, even if it's $5. The machine is more important than the amount. If you want a balanced starter that teaches while protecting, split your 100 like this: 60 into a broad index fund, 20 into a diversified REIT, 10 into a gold ETF, and 10 into Bitcoin or Ethereum if you've done the security homework. This mix gives you growth, income, ballast, and a small exposure to a high-risk Howard frontier. If you want an education with guardrails, try this: the 70 into an index fund, 20 into a REIT, 10 into a single company you research for at least 2 hours using a checklist. Keep a journal of your stock thesis. Revisit it quarterly. If your thesis changes for the wrong reasons, price alone, learn the lesson and adjust. Whichever model you pick, wrap it in 4 rules. First, automate contributions the day after you get paid. Second, never invest emergency rent or food money. Third, commit to a minimum holding period for your core positions. Think in years, not weeks. Fourth, measure your behavior as much as your returns. The person who keeps compounding through boredom and drama wins more often than the person who guesses correctly twice. You might be asking, what about taxes? Good. That question separates dabblers from builders. If your country offers tax-advantaged accounts, use them. They are legal cheat codes. A Roth-style account taxes you now, but lets you enjoy tax-free growth and withdrawals later if you follow the rules. An ISA-style wrapper can shelter your capital gains and dividends up to generous limits. A TFSA-style account offers tax-free growth and withdrawals, but has contribution room rules. Superannuation and pension schemes have their own rules and incentives. The details vary. The principle does not. Place long-term investments inside the account types that minimize taxes and drag. If you have to choose between a tiny bit more yield outside or a tax shield inside, the tax shield usually wins for long-term compounding. Let's go deeper into the invisible skills that make your 100 matter. First, security hygiene. Use a password manager, turn on 2-factor authentication for every financial account, and prefer app-based codes over SMS where possible. For crypto, understand exactly where your coins live, who holds the keys, and how you would recover access if your device disappeared. Write recovery phrases on paper, store them safely, and never type them into random websites. If those sentences sound fussy, that's the point. Professionals lose fortunes to sloppy security. Don't be a professional loser. Second, fee awareness. Fees are compounding's termites. A 1% annual fee on a fund sounds small. Over decades, it can devour huge chunks of your ending balance. Prefer broad, low-fee funds for your core. Pay higher fees only if you're getting something exceptional and provable in return. Third, contribution discipline. When money arrives, your brain tries to celebrate by spending. That's fine. Celebrate small. But build a rule. Future you gets paid first. Even if it's $5, the habit matters. Raise your automatic contribution when you get a raise. If life punches you in the face, lower it temporarily, but don't turn it off. Keeping the pipe open, even at a trickle, preserves your identity as a compounding human. Fourth, volatility tolerance. Prices will fall. Headlines will shriek. Friends will panic or brag. Train yourself now with small amounts so your nervous system learns the cycle without wrecking your finances. When markets drop, ask, has my time horizon changed? Has my plan changed? Has my need for this money changed? If the answers are no, keep calm and keep contributing. The market's drama is a feature, not a bug. It's what delivers returns to those who endure. Fifth, narrative clarity. You are vulnerable to stories. This time is different. This is the next Amazon. Only fools invest in X. Learn to name the story you're being sold. Then ask, what evidence would make this story false? If the answer is nothing, you're dealing with dogma, not analysis. I promised a professor structure without putting you to sleep. So here's a 14-day beginner sprint that builds everything we've discussed into muscle memory. It's voice-over friendly, quick to follow, and each day is a single action you can complete in under 30 minutes. Day 1. Write your investing rule on a piece of paper and say it out loud. I use small amounts of money to build big systems. Tape it where you'll see it each morning. Day 2. Open one tax-advantaged investing account your country offers, or the closest equivalent. If you can't contribute yet, still open it and complete identity verification so it's ready. Day 3. Fund the account with 10. Set up an automatic contribution for the same day of the week, every week. The amount can be small. The automation is the victory. Day 4. Choose a broad, low-fee index fund and buy your first fractional share. Turn on dividend reinvestment if the platform allows it. Day 5. Read a 2-page summary of what REITs are and how they pay dividends. Buy a tiny slice of a diversified REIT if it fits your plan and is available within your account. Day 6. Write a 100-word explanation in your own words of why you chose your index fund and REIT. Keep it simple. This is your thesis. Save it. You'll revisit it. Day 7. Learn one security habit. Enable 2-factor authentication on your investing account and your email. Backup recovery codes in a safe place. Day 8. Decide whether you want gold exposure. If yes, buy a tiny slice via a reputable fund. If no, write one sentence why you're skipping it. Decisions beat indecision. Day 9. If you're crypto curious, spend 30 minutes learning how self-custody works. If and only if you understand private keys and recovery phrases, buy a tiny amount of Bitcoin or Ethereum on a reputable platform and practice a test transfer. If you don't understand it yet, wait. Curiosity is not a deadline. Day 10. Cancel one subscription you forgot you had. Redirect that amount into your automatic weekly contribution. Feel that small friction turn into fuel. Day 11. Build a one-screen money map. At the top, list your income sources. In the middle, list your automatic transfers. At the bottom, list your investments. Simplicity reduces anxiety and mistakes. Day 12. Write 3 never rules. Never invest with borrowed money. Never spend your emergency fund on investments. Never stop contributing completely unless you've lost income. Day 13. Read your thesis from day 6. Has anything material changed in your understanding? If not, do nothing. Doing nothing is often the work. Day 14. Celebrate your machine. Not the balance, the machine. Take a walk. Tell someone what you built. Consistency loves recognition. If you're still with me, and I hope you are, you've earned a few advance notes that most beginners never hear because they click away too quickly. Time beats timing. Dollar cost averaging, buying a fixed amount at regular intervals, will sometimes buy high, sometimes buy low, and always buy your sanity. The market rewards behavior, not brilliance. The second advance note. Diversification is not owning many apps or many tickers. Diversification is owning different streams of earnings, different asset behaviors, different economic exposures. An index fund gives you many companies, but it's still one market. Adding a REIT adds real estate cash flows. Adding a bit of gold adds a crisis hedge behavior. Adding a tiny slice of crypto adds a non-sovereign high beta growth bet. You don't need everything. You need enough difference that one storm doesn't sink your ship. Let's also demystify dividends for a moment. Dividends feel like free money. They are not. They're a distribution of a company's profits to you, which reduces the company's cash on hand. They can be wonderful, especially when they arrive steadily from REITs and mature businesses, but reinvesting them is where the compounding happens. If you want income today, you can take them as cash. If you want growth, reinvest them automatically. The magic isn't the check. It's the additional shares you now own. What about the person who says, I only have 25? Should I even bother? Yes, especially you. Your small amounts teach you discipline without scaring you away. A 5 weekly contribution is a 260 habit per year. Raise it by 5 each year and watch your own behavior compound. You're not trying to impress anyone. You're trying to become someone who funds their future first. What about the person who says, I missed the best years? No, you missed some years. The best years are the ones you actually invest in. If you're starting at 25, 35, 45, 55, your machine matters even more. You will probably earn more income now than you did at 18. You can play catch-up with larger contributions and calmer nerves. Don't waste another month negotiating with the past. Install the system. Let time do the compounding. A few tactical guardrails before we close. Never chase a yield you don't understand. If a platform promises double-digit returns on safe assets, read that sentence again until your skepticism wakes up. If a stock soars and you feel FOMO, step back and ask, if I didn't own this, would I buy it here? If a coin drops 40 and you feel despair, step back and ask, was my position size appropriate for my risk tolerance? Your feelings are signals. Train them, don't obey them. Revisit the 100 experiment one last time and extract the correct lesson. The best performer over the last 4 years was Bitcoin explosive, exhilarating, terrifying. The steady performers were index funds and gold, one built on company earnings, the other on ancient trust. The income surprise was a rat, where dividends turned a small price dip into a net positive. The cautionary tale was a randomly chosen single stock down a third, not because the company is terrible, but because randomness is not a strategy. In a different 4-year window, the order could flip. That's why we build systems and diversify. We respect what history suggests, but never bet the farm on one story about the future. If you want one sentence to carry into the week, take this. Compound behavior beats compound interest because behavior yields the interest. The habit of automating, the reflex to reinvest, the choice to learn instead of guess. Those are the gears that quietly turn your first 100 into your first 10,000 and beyond. Now take 60 seconds and anchor this. Say it out loud. I am building a machine that moves money from my today to my tomorrow. Then take the smallest next action that proves it. Open the account. Set the 5 automation. Buy the first fractional share. Write the thesis. Lock your security. There is no perfect moment. There is only the moment you decide you will be someone who invests, not occasionally, not when it's exciting, but always. Years from now, someone will ask if you got lucky. You'll smile. Luck visited, as it always does, but you were already in motion. Your 100 didn't vanish into noise. It became a signal. The day you stopped renting your attention to other people's goals and started owning a tiny slice of your own future. That's how beginners really begin. That's how the compounding game becomes your game. And that's how your laptop and a single bill turn into a quiet, relentless engine that doesn't need you to be brilliant, only consistent.